All right. Thank you very much to Quantifi for inviting me. I am Patrik Karlsson. I work at ICMA, International Capital Market Association. And I run something called AMIC there. You're wondering what the AMIC thing is. It's not just the ICMA letters bundled up. It's just not another thing of it. It's the Asset Management and Investors Council, we call it. So ICMA has around 500 members. We provide market guides, market practices for our members, primarily in the area of repo and fixed income secondary market trading and fixed income primary market syndication. You probably wonder what asset management has to do with that. Well, of those 500 members, about 160 are broadly defined buy-side, primarily third-party asset managers and insurers, pension funds, sovereign wealth funds, even private banks, if you can call them buy-side. So I run that AMIC bit of it, and I'm going to talk to you about fund liquidity risk and leverage risk in investment funds. So I'm primarily concentrating here on investment funds. And I have to apologize, compared to the last panel, this will be at a huge helicopter level. I mean, some very simple stuff that you probably all know already. But they did give me half an hour, so I'm going to take it. Sorry, guys. You're stuck with me. So, why liquidity risk management? This is a debate that we engage with as a trade association with regulators and central bankers, primarily. This is where this comes from, this report that I've written. The report looks like this. It's extremely boring, but relatively simple nonetheless. And it is available on our website. There's a link at the end. We were noticing that the debate on systemic risk was increasingly encompassing asset managers as well as the banks that have separate legislation in place, rules in place, recommendations in place from the Basel Committee, insurers from the IAIS. They have a GSI process as well for their systemically significant ones. And then the asset managers were next in line. So you probably know this, there's been several consultations already by the FSB on designating systemically significant non-bank, non-insurers, which is code for asset managers. And as part of this debate, the most frequently quoted risk in asset management was liquidity risk, maturity transformation. So we thought, well, there's already a bunch of rules and tools available for investment funds in Europe, and I do stress that this is a European paper primarily. So we thought we would document them. Now, you may probably have a lot of experience from using liquidity risk management tools. We'll get into swing pricing, side pockets later. But the paper doesn't actually go into, for example, the reputational risk of using them, either alone or among others. We just kind of quantify what they are, because we felt that even this level of knowledge was lacking. But we thought this was a problem, so we wrote this report, and I had a very, very helpful cooperation with the European Fund and Asset Managers Association, EFAMA. They represent primarily the mutual fund associations at a European level. I think I've gone through pretty much all of this. Yeah, the primary regulations and rules that I'll be talking about is the UCITS directive and the Alternative Investment Fund Managers Directive. These are, of course, not new to anyone, I'm sure, but they are the ones from which most of the rules stem from, and where many of the tools have been developed from as well. Not surprisingly, this being an industry report, we concluded that these rules and tools are perfectly sufficient to allow fund managers, fund management companies, and the industry to manage liquidity risk in their funds. I'll also speak a little bit about leverage towards the end, because this is another one of these major sources of risk that have been identified by the policymakers in targeting, or how to speak, speaking about our industry. This I don't need to spend too much time on. I suspect I'm in a room full of experts. But we thought that it would be useful to document a little bit about the practical risk management practices in investment funds and investment fund companies. By the way, I will be using those terms intermittently and interchangeably. So apologies, I don't intend any confusion. I do realize that there are differences between a fund and a company. But often the processes that are used are centralized at the company level, even though they are applied at the individual fund level. So we talk about the importance of the product design phase, understanding the audience that the fund is intended for, understanding the kind of strategy it uses, particularly the kind of assets, obviously, it's going to be investing in, and how that matches up with the risk appetite of the audience, and what the liquidity risk profile of those assets are. Of course, it's not just the assets, it's the investors themselves. There are redemption risks that have to be modeled in the product design and the day-to-day management phases. The most important part is the product design phase. If the product design is wrong or doesn't take sufficiently into account of liquidity risk, then there could be problems for the future. We also talk about the day-to-day liquidity risk practices, kind of just monitoring of assets, monitoring the liquidity of assets, understanding your audience well enough to know when redemptions are likely, particularly large redemptions. So dialogue with your investors, understanding market liquidity of your assets are key. Existing legal tools, I think we're fine. So this is the slide I want to talk about next. The existing legal tools. These may be well known to you all, but nevertheless, I'll go through them a little bit at least. Both the UCITS directive and the AIFMD directive. Actually, hang on, let me specify what I'm talking about. So the UCITS directive is primarily UCITS 4, 2009-65. There is a UCITS 5, of course, but that didn't specifically amend the original UCITS directive with regard to liquidity risk management. So the tools that I'm looking at here stem from the 2009 version of the UCITS directive. AIFMD, as you know, came into force, or was agreed in 2013 and has recently been applied subsequent to Level 2 measures being introduced. UCITS also has a number of guidelines, originally from CSER, the Committee of European Securities Regulators, and lately from ESMA since 2010, the European Securities and Markets Authority. So, what are these legal requirements and tools? They're not really tools. I think that's probably not a great title for this thing. They're more like requirements, basically. But it's worth bearing in mind, because when I hear central bankers talking about shadow banking, it's as if there are no requirements and no tools. And when in fact they talk about shadow banking, they often talk about investment funds, performing tasks that perhaps in the past have been performed by banks, particularly credit. So, requirements. There's an independent risk management function. It's self-explanatory. So these particular risk management requirements, what are they? I mean, they're sort of like a heading for the ones below. Monitoring the liquidity profile is mandated in the legislation, and a system for having that monitoring and addressing any shortcomings have to be documented and disclosed to the regulator and your investors. So the liquidity profile have to be monitored. Stress testing is rigorously prescribed in both the AIFMD and UCITS, and are often used and rigorously used. And of course, everything is disclosed, or most of it is disclosed to regulators and investors. Now, I know that the next panel is going to look at some of the specific liquidity risk management tools. So I don't have to spend too much time actually on this next slide. I think the point is that we wanted to make clear, at least in Europe, and in which jurisdictions in Europe, many of these tools are available. So, ignoring the old slide for a bit, swing pricing, dual pricing, dilution levies, they are tools that basically, as I'm sure you understand, they transfer the cost of leaving a fund to those who are leaving and trying to protect the remaining investors. These are not uncontroversial tools. There are differing opinions even within the industry. That's the one. That's it. Oh. Thanks. Yeah, no, I mean, so swing pricing isn't an uncontroversial tool. I've heard it called a franchise killer even, because you are punishing investors for leaving, essentially, the fund. I think that there is a majority of opinion among our members, at least, that it is a useful tool. It's good to have. Of course, it has to be used judiciously, like every tool here. These are extraordinary liquidity risk management tools. It's not a case of buying another bond because it's more liquid than an illiquid one. This is when things are genuinely dislocated in the market, or you're facing exceptional redemption pressures. So yes, swing pricing. And there's a full swing pricing possibility, or a partial one, where only part of the cost is swung to the leaving investors. Dual pricing is when you establish two NAVs, essentially. Dilution levies function in the same way. In-kind redemptions is a measure, as it says on the tin, that kind of tries to protect all the remaining, both the leavers and the remainers, by not dislocating the assets in the fund by having to sell them. This is quite a rare tool, the in-kind redemptions. It's rarely used. Tends to be very large investors who are comfortable redeeming securities instead of cash. It is rarely used and not very popular with investors. Out-of-the-money gates, any kind of gates, suspensions of dealings, they have a big reputational impact, as you can imagine. We've all seen the headlines, we've all read a lot about the commercial real estate funds in the UK after the Brexit vote. I'm not going to say too much about that, but I think from a policymaker's perspective, one could argue that exactly the right tool was used in the situation that arose. And that since the funds have reopened and started trading relatively normally, it was a defensible use of the tool. It wasn't easy at the time for the companies that had to do it, but you could make a credible argument, and we would certainly at ICMA and my part of it, AMIC, say that it was appropriate to use them, and the tools are there precisely for this purpose. Side pockets establish certain assets within the fund as a side pocket and are protected from redemptions for a while, at least until the market dislocation goes away, and can then be sold and a single NAV can be re-established. Then the final one is probably the most controversial one, at least among our membership when we discussed this, when writing the report. This is temporary borrowing from non-government sources, credit lines essentially. We talk a little bit about the different kinds of credit lines. They can be committed, they can be uncommitted. These have a cost, of course, particularly for usually the bank counterparty, and that cost has to be borne in mind. I think the key thing here is that we really strongly made the point that they shouldn't be misunderstood as a kind of redemption risk tool. So we found this very useful table. Fortunately, we didn't have to write this ourselves. We just copied it from IOSCO. So IOSCO had this report that they did a survey among their members, the securities regulators among them, of what tools they have to manage liquidity risk in what they call collective investment schemes, CISs. So you can see here the European countries and what's available where. Not surprisingly, Luxembourg and Ireland have all of them, and that's where the vast majority of funds are domiciled. Germany, as you can see, not a lot, and they have actually approached us since to try and see whether they should try to introduce swing pricing. So that's an ongoing debate, and I think it's useful to highlight. One of the key messages we wanted to bring from this is that these tools can be useful. They can be extraordinarily useful, but they are by their nature extraordinary, and not to be used lightly, of course. We have some recommendations. We thought it wasn't just enough to document what was there already. We thought we'd have some helpful suggestions. Actually, they're not that helpful. They're pretty much motherhood and apple pie. But nonetheless, they round out the report. we wanted to stress what I just said, basically, that the use of these tools is helpful and can be helpful, and they should be available. The key point isn't that they should be mandated to be used in certain cases. They should just be available for fund managers to use, or fund management companies to use as relevant. As you know, in almost all of these cases, none of these tools are used without the permission of the regulator, the competent authority of the fund. So it's almost always a dialogue between the regulator and the fund, and they are only used then. But clearly experience has shown that they are useful and need to be available at least. Data is another question we looked at a lot. We found, particularly in AIFMD, that there is a lot of data disclosure requirement already, particularly towards the regulator. And because we feel that the regulatory debate is around gathering even more data, I think we just wanted to encourage the authorities to use the existing data better than they already do. And at least to make sure that when they're considering systemic risk at a European level, that they ensure that they actually have access to all the data. So, for example, there are regrettable cases where, for example, leverage disclosure only goes as far as the national regulator. And ESMA, sitting in Paris, trying to understand the systemic or the European amount of leverage, really has no idea. And he has to then go to each individual regulator and have 27 different, 28 currently, but 27 soon, different dialogues with the national authorities about leverage. We don't think this is helpful, and this should be automated much more. And the final one is just to also encourage national associations, where appropriate, to develop guidelines to help investment funds in their jurisdiction. The most and best one probably is ALFI in Luxembourg. They have an extremely useful swing pricing guide, which I find both accessible and useful. So if you want to look into swing pricing, then the ALFI, the Association of Luxembourg, swing pricing guide is the best one. I have 10 minutes left, so a few more words on leverage. So in addition to liquidity risk, both on the asset and redemption side and the tools to manage them, we want to talk a little bit about leverage risk, or lack of risk. So the FSB has recently consulted on policy recommendations to address structural vulnerabilities. So this is as opposed to the designation of individual systemic entities. They want to look at activities instead and try to address measures aimed at activities so that the system is safer. We very much welcome this approach because we had criticized the designation of individual companies as flawed. Nonetheless, one of the problems with the FSB consultation is that they are worried that there is no one measure of leverage in the world in investment funds. So whereas the Basel Committee can relatively simply say the amount of leverage in the banking system, and the IAIS can say so for insurers, the IOSCO cannot really do so for investment funds yet, or collective investment schemes, however you want to define them. So as a result of this, their proposal is, let's have one, what they call simple and consistent measure of leverage, and apply it across the world so that we have a better idea of potential systemic risk with the fluctuation of global leverage. Not surprisingly, we really didn't like this approach because there are already many different measures of leverage for investment funds. The problem with a lot of the regulatory dialogue is the treatment of collective investment schemes or investment funds as one type of instrument, one type of fund, one type of asset, basically. This is a problem because UCITS funds, basically mutual funds, and AIFs, hedge funds, private equity funds, anything that isn't a mutual fund, in Europe have different methods of measuring the leverage. And there's a reason for that. So there's a gross method, commitment method in AIFMD. VAR is used to measure the impact of derivatives. I mean, these exist side by side. They are used in different funds in different ways. They are allowed by the regulations to do so, and they are encouraged by the national competent authorities, the regulators, to do so as well, because they make sense. There's different strategies involved, different kind of assets in the fund, different use of derivatives, obviously, and different risk appetite from the investors. For example, a UCITS fund will have a very different risk appetite than an AIF. So we made a strong statement that this should be allowed to continue. And any kind of leverage measurement in the investment fund world should take into account multiple methods. That's basically what it is. So we didn't want fund managers, fund management companies, to have to necessarily change what is currently working, multiple methods tailored to the type of fund and the type of investors in the fund, in order to help the FSB and IOSCO understand systemic risk. Just a few words on next steps. I might allow some questions, but if they're difficult, I'm running away. We've done the usual trade association work of responding to consultations and feeding in and talking to regulators, etc. IOSCO is updating their 2013 principles of liquidity risk management. These are non-binding principles that the IOSCO produced. They're not particularly onerous so far because the EU legislation that I've just accounted for already covers most of it. But this is going to be reviewed now as a result of this debate that I've just alluded to. And to follow up this riveting report that we've done on liquidity risk, I think we're next going to do a similar one on leverage to build on some of the ideas that I gave you in that last slide about the use of the current measurement methods, why they are used and why they are useful. And the idea is obviously to try to influence and engage with policymakers on the issue of leverage and the measurement of leverage, not only in light of the FSB and IOSCO work at the international level, but in Europe there's a very large review of the AIFMD looming already next year, even though it hasn't been in force particularly long. So that is what we are doing next. Now, easy questions, please. Any? No? Okay, fine. Hard questions, all right.
Sorry, I'm hogging the questions. In the context of commercial property in the UK or in a wider context, for those sorts of funds with the liquid assets in them to give daily liquidity seems to create both a cash drag and a false impression to investors as to what they're really buying into. Is there an argument to say that liquidity to investors should be reflective of the liquidity of the underlying assets, and then hopefully that takes away some of the issues around what happens in a time of at least light to moderate stress?
Yeah, I think there is. I mean, we've had now 3 times suspensions in the last 15 years in these types of funds. It's not good. But then again, why is there continuing demand? I'm genuinely surprised. I just work in a trade association, so I can't answer your question fully, but I'm wondering, why is there continuing demand for investors for daily liquidity in an illiquid fund, essentially, in a fund investing in illiquid assets like commercial real estate? I don't really understand it. I actually agree with you. I think liquidity of the fund should reflect the assets, so the redemption should reflect the assets, and we should be looking at closed-ended structures for these. It may be that we have tried, and we have simply failed because advisors or investors themselves just say, no, I want that daily liquidity. It may be that investors are so sophisticated that they say, I know that there is a relatively higher risk of suspension in this fund than in others. I'm willing to take that risk, and in good times I can take my money out. But I know that in bad times it'll be suspended quickly. It may be. I know that the FCA is thinking very hard about this and may be coming out with some tougher recommendations on this as well.
If I might follow up, I think, firstly, I think there's an argument for saying that, given that you're saying that investors are sophisticated and they are assessing those risks, then perhaps the fund should be more explicit about what order they implement those potential mechanisms in place. So yeah, potentially that's something. The other thing is there's an argument for saying that in good times there is daily liquidity because you've got people coming in, people coming out. I don't know how you implement it, but there is a nature of open-endedness to these funds in that if they're doing well, more money comes in and the fund managers get rewarded in that sense. Maybe there needs to be some sort of hybrid development of funds which give an open-ended nature on a less frequent basis, alongside maybe a tradable market which trades at a small premium or discount. So it's sort of closed-ended for during the month and then open-ended at the end of the month, and the fund manager can effectively sweep up the net demand at the end of the month.
Yeah, that may be. Absolutely. When there is higher subscriptions, yeah, that's good. And redemptions can be met relatively easily. And there are, of course, cash buffers as well to deal with some of these things, but cash buffers are never usually that good. I agree. I think it would be helpful if we could explore some hybrid liquidity solutions. I'm sure you know this, but there is no actual legal demand for daily liquidity in UCITS. Not that these were not UCITS funds, by the way. They just promised daily liquidity even though they weren't UCITS funds. But there isn't actually a daily liquidity demand in UCITS. It's actually twice a month. It's just that the distribution networks in Europe have developed around daily liquidity, presumably from investor demand. But just to be clear, there's no legal requirement to provide daily liquidity. I think that's a very, very helpful intervention. Thank you. Yes, please.
In terms of the response from the industry and from the buy side in terms of the liquidity, are you finding that, from your opinion, is the response adequate? Is it something where you feel you have to get people's attention, or you think that your members are actually coming to you looking for?
A response in terms of reflection in the policy debate? I don't know. I think we've made some difference. I think just the fact that the FSB moved away from designating individual entities to talking about activities is really helpful. Just the problem is that they don't really take into account of the existing mitigants. And then I've been talking about mitigants now for half an hour, so I think there's still some way to go. But I think we've hopefully made some difference at least. If nothing else, then I think just on time actually. Yeah. Thanks.